Good evening, everyone. We should be starting in a few minutes from now. Good evening, everyone. We welcome you to the ASK Investment Managers quarterly update call on ASK India Vision Fund and ASK Golden Decade Fund. I'm your host. My name is Rahul Goyal and I manage business for South India for ASK Investment Managers. And today I have the pleasure of introducing Mr. Kuldeep Gangwar, who manages ASK India Vision Fund and ASK Golden Decade Fund. To know more about the portfolio manager, Kuldeep has more than 18 years experience, out of which about 15 years of experience in the equity markets. This experience includes more than a decade in the sell side research. His main domain expertise is in FMCG and retail. Prior to joining ASK, he was with HSBC Securities and Capital Markets India Private Limited as a sell side research analyst. He has also worked with Tata Motors for about 3 years. Mr. Gangwar is an MBA Finance from IIT Bombay and an BTech Electronics and Communication from IIT Roorkee. He's also a CFA charter holder. He joined ASK in January 2018. Over to Kuldeep to take it forward. Thank you.
Hi, good afternoon, everyone. India Vision Fund and India ASK Golden Decade Fund, it's all about India's story. We generally come across that India is fastest growing economy. When an economy is growing quite fast, obviously there are sectors available which do even better. And within those sectors, there are the companies which have right to win. So endeavor is to figure out the sectors, the themes, the companies, which can be the beneficiary of the India story. And we will be dealing with that part of the portfolio construct in a while. Before that, a common question like where we were, say, 3 months back, that obviously the negative news like inflation is running high. There were the question whether we were moving towards the recession, especially in the developed market. There is war in Europe. There is high global debt. Weather conditions are quite erratic. So a lot of negativity. We discussed last time that things are changing. We have made further progress in that direction. So if we think about India as a country, like we are net importer. We import a lot of commodities. If the prices are high, it hurts us. And if it's standing other way around, it helps. So if we look recent picture and we think how the commodities have moved in last 1 year, crude oil prices have come down by more than 40%. Metals have come down ranging from 17 to say 43%. Agri commodities have also come down. In a way, we can say that the things are moving where we desire them to be. And it should help in the easing inflation. It shows that last year, February, we hit crude oil price of close to $128 per barrel. It has come down significantly. And we meet 80% plus requirement to import. It's the largest contributor to our import bill. And if the crude oil price is coming down, it's a good news. Supply chain is dependent like freight cost. We have seen during the COVID time, the freight cost moved significantly. It impacted the overall margins for the companies. And now it's moving toward the pre-COVID level. Agri commodities are also coming down. which is helping to bring down the overall inflation. If we think and summarize about the overall picture, at global level, we can say inflation is coming down. Probably US has reached to the level that incremental rate hike will be rather minimal, and they will be crossing the hump in due course of time, say in a couple of months or so. As far as India is concerned, like RBI took a pause in April, and since then the market has also rebounded. If we think about, say, overall macro situation for India, we have relatively lower food and fertilizer burden in FY24 and beyond. There are many tailwinds available. Today, we think about China +1, Europe +1. We are doing a lot of things on ground, like providing incentive through PLI, which is helping our local manufacturing. Capacity utilization has reached to the level that private capex will be also required. So, from macro situation perspective, probably India is one of the better placed economy globally. But whenever we think about fundamental, we do think about, say, what it means for the stock market. If we look for the long period history, like close to 30 years, it appears that earnings and the stock market performance on the long period basis go hand in hand, like close to 11-12% earning growth in last 30 years, and almost say similar sort of return being experienced by market. But if you are looking at this slide, it is also quite clear that it does not happen in the linear fashion. There are periods when the earning growth are relatively superior and price performance come over a period of time. Why it happens? Because apart from fundamentals or earning growth, it does require that how it's being appreciated by the market participants. So last 4 years, we had pretty decent earning growth, but it coincided with our time when the FIs were withdrawing the money. Like if you look September 21 onwards, there was significant pullout from India. So despite having robust macro, superior earning growth, one of the best fundamentals globally, we couldn't perform. It has changed in last 3 months. That same narrative has changed to the situation that today we are talking about that the worst is over, earning growth remains resilient, and valuation have also become reasonable. So earning growth getting appreciated in last 2 months has reached to a level where we have seen close to 8-9% say stock market performance for the overall indices. It coincided with a phase that local money had been there, is there, and likely to be there. It had been a resilient flow in last many years, last many quarters, and last many months. So today, we are talking about a scenario that local money is getting into the market. It's also well supplemented by, say, global money. And that's the reason that we are able to get the appreciation of, say, earnings which we are delivering on ground. If we think about the valuation, so in last 1.5 years, market delivered earning, but at the same time, the trailing peak came down. So it used to be, say, 27, 28 in December 21. It came down to the level which is quite close to the 10-year average. And I will like to highlight a point that 10-year average itself is not the right metric to look at. Reason, the mix has changed. So in last 10 years, the composition of Nifty has changed dramatically. Today, many quality high growth businesses are there in the Nifty, which command relatively higher valuation. Vis-a-vis, say, PSU, oil and gas, and metals in past, which traditionally used to command lower valuation. So theoretically, the valuation should be higher than the 10-year average. But nonetheless, given the correction, we can say today the valuation is relatively more reasonable. If that is the case, then there is high probability that if the earning growth are coming, then it should translate into the stock return as well. And that is the area where we are quite confident that earnings should keep on coming for the overall market as well. Like for for next couple of years, the earnings should be low teen to mid-teen CAGR, and it should provide enough tailwind support to the overall market to perform from at least 2 to 3 year perspective. In this environment, if we think about India vision strategy or say golden decade portfolio, this particular strategy is focused on the value migration. As I mentioned that in any economy, there will be sectors which will do better than the underlying economy growth. And within those sectors, there will be the companies who have right to win. So what is value migration? That there are multiple factors that the people make a choice. Sometimes it may be the better technology, it may be convenience, and so on. Some of the examples may be like there was migration happening from say global or say developed market to India in terms of IT, pharma, because we were relatively more cost competitive. Similar situation can be in financial market, like 20 years back, it was only about say trust. You were giving your money to banks and you just used to expect that as and when required, I will be able to get it back. Over a period of time, the trust is being acquired by better rated NBFCs, banks, who not only provided your money back, they also bring on table the convenience part, technology part, new products. Everything can be done on the fingertips. So we can call it constructive distraction. Like they are companies who provide better offering, and that's the reason they have the structural tailwind available. Same is the case with consumption. Like consumption obviously had been the anchor for India growth story. 60% of the GDP is led by the private consumption. The question is like who is going to serve the changing need? So branded company, organized company who have say new products, better reach, who can also offer the premiumization. Those are the companies are actually offering faster growth vis-a-vis say underlying the say sectoral growth over there. So we have identified 5-6 themes in this particular say value migration proposition. Consumption, as I mentioned, had been the anchor of India growth story. So even in pre-COVID scenario, 5 years back, 10 years back, whenever we think about say India story, it was that we are domestic consumption-led growth story. Question is, if a need exists, who is going to serve that need? Take the example of Titan. Like 20 years back, we used to stay at one place. We used to have a concept called family dweller. Today it's changing, like people are moving from one place to another. It may be one city to another. At the same time, the need exists like contemporary design, quality, trust. No better player available than Titan, that who is bringing everything at the same go. And that's the reason that Titan has delivered more than 20% growth for last many years, including the last 3-4 years, where there was significant disruption. We do believe it should continue because there is a desire for say jewelry sector. The only thing is it's moving more in favor of say organized retailers, and Titan is the major beneficiary in that area. So consumption remains a major theme. Titan is just one of the example, and almost 30% of the portfolio is coming from say consumption part. Next is financial. As I mentioned that for any sound economy does require a sound financial system. Generally, the credit growth is linked to the GDP growth itself. But there are better run banks, better rated NBFCs who do much better than the system level growth. And that's the reason, again, private banks have done quite well in last 10, 20 years or 30 years, and it should continue to happen. So if the credit growth is happening, say at low teen level, and these private banks, better rated NBFCs have potential to grow from 15 to 20% CAGR for next 5 to 10 years. And it is this is the performance of BankX, like it has significantly outperformed, say, Nifty over a long period of time. So consumption and financial had been the traditional themes available to us even in the pre-COVID scenario. What has changed since then? Like any opportunity, also any say crisis also offer the opportunity, and this is something which happened with India, like something like chemical sector, which used to be considered more commodity-driven sector. The nature of that business is changing. Today, India is having many levers, at least in terms of its chemical offerings. So if overall chemical sector might be growing at high single digit or so, India can benefit from China plus one, or now say Western Europe plus one, because we have very low market share in overall opportunity. So shift in the market share along with the overall growth in the chemical sector is providing the natural tailwinds. And within that, they are the players who have the proven track record. And now instead of moving year to year, they have long-term contracts available, which in turn providing a compounding opportunity, sustainability of the growth. So it's one of the major beneficiary in the post-COVID scenario. Another theme had been like the government is trying its best to provide tailwinds to the manufacturing. We used to have close to 14% of GDP in manufacturing, and endeavor is that it should increase to close to 25% in time to come. So whether Make in India, CapEx, PLI, all these are initiative in the same directions. And we are already benefiting from the same. So just to give an example that a smartphone export used to be hardly 1,500 crore in 2018. That number has increased to more than 80,000 crore in FY 23, and a long way to go. So we are not talking about incremental growth in many areas now. We are talking about exponential growth. And some of the PLI scheme have yet to come. So probably we have started the journey, a long way to go. So digitization is another theme which got the benefit in the post-COVID scenario. EV obviously is a structural trend happening through, say, people moving from internal combustion engine to, say, EV side. So this is another opportunity available. Net, we have 5 to 16, which should be a structural winner in next 5 to 10 years. And we have tried to figure out which are the companies who should benefit from these trends. So this is a psychographic of India Vision and the Golden Decade portfolio. As I mentioned, close to 30% is coming from consumption. Another 30% is coming from, say, financial. Then platform, telecom, software services combined are having close to 12% contribution. Chemical is another overweight area where we have more than 10% exposure. And so is the case with manufacturing. So overall portfolio is tilted towards the growth sector and the growth companies. And it's not about a year. If we look these companies for last 5 years, they have a strong growth track record, both on, say, top line as well as bottom line. At the portfolio level in FY 17 to 22 period, the average earning growth would have been 20% CAGR, vis-a-vis, say, Nifty earning CAGR of close to 11%. And this momentum has sustained even in FY 23, where many up and down were happening globally, whether it's a Russia-Ukraine war or its implication for inflation, its implication for interest rate, and so on. In Q4 FY23, the operating profit growth for the portfolio was close to 23%, vis-a-vis, say, 12% for the Nifty. Full year, the picture was also similar, close to 20% earning growth, vis-a-vis, say, low teen for the Nifty. And we believe it should sustain even in time to come. Like in FY24 and FY25, we expect close to 20% plus earning growth for the portfolio, vis-a-vis, say, low teen growth for the Nifty 50. Point is, like, we try to have exposure for high quality, high growth companies who had perfect past, who have delivered in recent past, and who should continue to deliver in future as well. This is a psychographic, like strong earning growth, high return on capital employed. When we deal with this sort of companies, the only question comes, at which price these companies are available. At any given point of time, for portfolios to perform or stocks to perform, 3 things are required. First is the narrative, like what is the bigger picture? Second is the earning growth, like fundamentals should in place. Third is the valuation. So till March 23, the narrative was negative across the board for equity. Like we were discussing about, say, Russia, Ukraine having implication for, say, commodities, crude oil moving up, inflation high, which is leading to a situation that, say, most of the central banks were raising the interest rate, which led to a situation that expectation from the equity rising, having a higher cost burden for, say, most of the companies. That narrative of having only negativities across the board is changing now. Today, I have already mentioned that RBI has taken the pause in terms of raising the further interest rates. Most likely, say, Fed should also do the same in coming month. So the picture is like today we are thinking about the worst is over and things are improving on margin. I mentioned that earnings were there, so fundamentals were intact. This was the strongest anchor for our overall story. So narrative changing from negative to positive, earning growth remaining resilient, and for whatever we have seen in last 1.5 year, the valuation also become quite reasonable. So if we look the picture now, the trailing P for this particular portfolio is quite close to the bottom what we have seen in last 4 years. And last 4 years had been the period when we have seen it all, whether it was COVID-1, whether COVID-2, Russia, Ukraine, inflation, interest rate. So whatever could have gone wrong has actually gone wrong. And whatever worst valuation multiple we would have seen in last 4 years, we are quite close to those numbers only. And why we are saying so? So despite that earnings coming in last 1.5 year, it did not translate into the good stock return. In fact, CY22 was quite adverse for us, and so was the FY23. It has more to do with the 3 to 6 months not working out well. At the same time, the earnings were coming. It led to a situation that the multiples came down by almost 1/3. And today, as we speak, the multiple has reached to the level where they are quite close to the bottom being experienced by this particular strategy. If that is the case, then in future, if the earning growth remains strong, there's high likelihood that it should also start translating into the good return. And we have already seen a part of it. Like in last couple of months, close to 12.5% return has come for simple reason that earnings have been strong, is strong and likely to remain same. It's only about the appreciation of the same is happening now. So this is something I'm saying like CY21 and CY20, almost 24% CAGR. CY22 was a difficult year. It has started changing in CY23. And I'm saying the valuation today is at the juncture where further derating looks relatively having lower probability. And if that is the case, and we do believe that earnings should remain strong like 20% CAGR, a decent part of that should translate into the stock return as well. In summary, like the macro environment remain uncertain, but at the margin, the things are changing for good. We are invested in the areas which are more aligned to the fortune of the country, like growth story of India. We have always been invested in high quality, high growth businesses. In last 1.5 years, that the growth strategy, growth style was bearing the brunt of, say, increasing interest rate and so on. But it's changing now because earnings are there and probably interest rate have peaked out. Therefore, we believe that as long as the earnings are coming, fundamentals are intact, there is high likelihood that we have good days ahead. I will stop over here and will be happy to have any question which you might be having.
Thank you, Kuldeep. I would request participants to please enter your questions either in the chat box or in the Q&A session. The box is there. Kuldeep, the first question which has come in is Infosys results were not in line this quarter, and their guidance is very negative. What is your view on the stock Infosys Technologies and the IT sector as a whole?
So if you think about IT sector, it offers many things like uh, return on capital employed is high, significant cash flow generation, they distribute all of it. It does provide, say, significant support to our own current account. So it's a natural balancing act which is being done by this particular sector. And probably this is a sector from where our own story started, like India's middle class. Like this is a sector which has provided employment to the middle class in this country. So when we think about domestic consumption story, it's a must-have and one of the most important sectors. Today, we have seen that Q4 result for Infosys were not good. They reported Q&Q decline in terms of the constant currency, say revenue growth. For FY24 basis, they are talking about 4 to 7% constant currency growth. In INR terms, it will translate into say high single-digit top-line growth. If margin remain say almost stable, then the expectation in terms of the earnings should be high single-digit, low double-digit. And from medium to long-term perspective as well, that is the reasonable expectation from a sector like IT, which is dependent on, say, developed market for their outsourcing need, their IT requirements. I will like to believe that the earning growth should be in high single digit to low double digit. The question comes at what price those things are available. So significant correction is being experienced by the sector, including Infosys. Valuation have become quite reasonable now, like close to 20p about 24. It's quite reasonable. And if we are thinking that say low double digit sort of earning growth from 3 to 5 year perspective, in addition to the same a good dividend yield, it's a good place to be in after the correction now. But if overall IT sector, as I mentioned in earlier remark, that we are generally focused in the growth arena, and that's the reason as a sector exposure, we have only Infosys as our portfolio exposure being concerned. So close to 4% weight is there, which is significant underweight position vis-a-vis say market where the weight of this sector will be quite close to 12%. So it's more about that decent company, decent sector, but we want to limit our exposure in that area irrespective of the situation.
Thank you, Kuldeep. One of the questions from Rohit: what are the nifty components, sectors, which are expected to perform poorly in the next 3 years, maybe to avoid those sectors for the next 3 to 5 years?
So if you think about Nifty, so close to 25% is banking sector. Within that, private banks obviously have a significant, say, overweight position. Another 5-6% NBFC. So BFSI will be 30%. This is the area which is offering quite decent growth. Like if you look history, it has compounded at 15% plus CAGR for last many years. We believe it should continue to do that way. If you think about valuation, this is one of the areas where the valuation are quite reasonable. Like if you compare the banking or say NBFCs and the multiples vis-a-vis a pre-COVID scenario or 10-year averages, I would say valuation multiples are quite reasonable, either at par or at times it may be lower as well. It suggests that large part of the earning growth in that particular area will translate into the stock return. And that's the reason we have 30% plus exposure in that particular area. So banks close to 10% plus, NBFCs another 15% plus. We have tried to capture that particular growth opportunity through different names. But this is one of the areas which should do well, and we like to be there. IT, I mentioned that IT is having close to 15% weight in Nifty. This is the area we are relatively underweight. Like we have only 4% exposure for simple reason that IT as an opportunity overall, we believe the sector offer high single digit at best, low double digit sort of earning growth. So we have limited our exposure over there. Consumption is another 10 to 15% depending on when we are combining multiple subcategories. This is one area where we are over it because this is the area which offer high growth as well as the sustainability of the same. Another big area for the Nifty is oil and gas, like 20% come from that particular area. We have primarily Reliance coming from that particular, say, oil and gas sector. We have close to 5% weight. But again, oil and gas, we have a view, it's more commodity driven sector. So we just want to limit exposure where we have more visibility. So if we think about, say, I would say financial is something, consumption is something which offer relatively more visibility, steady, superior growth, and those are the area where we have taken the position.
Right, Kuldeep. The next question comes on Sona BLW. The Sona BLW, the promoters or key investors have reduced their stake. Is it a real concern to hold on to such a stock? Is one of the questions which has come.
So, as I mentioned earlier, it's not about a company, it's true for the market that for either stock to perform or the market to perform, first and the foremost requirement is that earning has to come. And in case of Sona BLW, we are quite confident that they have delivered in past and should continue to deliver even in future. So we are quite optimistic that that company offer 20% plus growth for many years to come. If that is the situation, then if the stock prices are actually coming down, instead of getting concerned about it, I will be taking that particular scenario relatively more positively because earnings will be coming at its own pace. The only thing is that now it's available at relatively lower prices, which is something happened in last couple of months. That after the PE exit, the stock has moved from say $400 to 530 within no time. So for company to perform, for economy to perform, fundamentals are required. As long as those are in place, sooner or later the appreciation of those earnings do happen, and it happens sooner rather than later. So for Sona BLW, we do believe they are available, they are present in an area which is a right area, like having relatively higher proportion in the overall auto market, and this is a company which is having 2/3 book which is based on EV, which is say close to 30% now. So I do not have any doubt about say growth prospects, and rest of the things do happen in short period of time, but as long as earnings are there, I'm okay.
Thank you, Kuldeep. One question from Mr. Balaji is that when do we plan to take drawdowns in our Golden Decade Fund? We have, there will be a, the drawdown notices would be sent to clients on 19th of June, and we would be having 3 allotment dates for Golden Decade Fund Series 2. The first allotment date would be 23rd June, Friday. The second allotment date would be 30th June, Friday. And the third and the last allotment date would be 7th July on a Friday. I hope this answers Mr. Balaji. Kuldeep, the next question is on compared to Nifty 50. How much better do we expect the Nifty next 50 to perform over the next 3 to 5 years?
It's a difficult question in a sense that the composition keep on changing, and we have already seen that there are companies in next 50 which do move to the Nifty 50. So if you think about overall market, I will like to believe that broader market do offer say low teen to mid teen earning growth. And if we believe that multiples are reasonable, as I mentioned, that it has come to the level where further drawdown should be lower, that should be the that should be the realistic expectation for the market performance as well. Like low teen should be the say market return expectation when we think about say 3 to 5 year perspective. But between Nifty 50 and next 50, the point is like the shift keep on happening every 6 months or so. So difficult to call in that way.
Thank you, Kuldeep. One question for Mr. Tarvinder. What is the expected annualized return being targeted in the Golden Ticket Fund for the investors? And how are we presently performing against this specific goal over longer periods of time?
So I try to answer that particular part, that at any given point of time, return are combination of two things. First, the earning growth. Second, the valuation movement. So if we think about the valuation movement, it was not favorable in CY22. While the company is performing, delivering decent earning growth, like FY23, almost 20% earning growth came. But say muted return or say negative return in FY23, it led to a situation that valuation came down. And the area where we are placed, like we just look for the high quality, high growth companies. So actually the concerns are good because it increases the possibility that the future return should be superior. Because whatever we choose, we don't have any doubt about the long-term prospects. We do not have doubt about the earning growth potential. The only question comes at what price. And as I highlighted that by March 23 end, valuation came to the level which was at the lowest level being experienced in last 4 years. So if that is a situation, there is high likelihood that if valuation remain at the current level, like further drawdown is not happening, then earning growth will start translating into the stock return. And that is something we started experiencing in February, April 24 onwards. Like in 2 months, there were decent recovery, like 12% plus return. And I would say it's still in the recovery phase, a long way to go. As long as we are able to say figure out the companies which are offering 20% growth, and we think about 3 to 5 year period, and if it's happening that way, and if the valuation has come to the level where probability has come down to go down further, then a decent part of the earnings should translate into the return.
Thank you, Kuldeep. A question from Nitesh. Can you throw some light on Patanjali Foods?
So Patanjali Food, if you look, the story is more about company transforming from commodity business to brand business. So when the Patanjali Group acquired Ruchi Soya, it was largely about edible oil, almost 97% profit or 97% revenue, and 90% profit used to come from the edible oil, which is commodity. In last 1 year, the Patanjali Ayurveda, which is the promoter, transferred its food business, packaged food business to Ruchi Soya. Name was also changed. So character of the business has changed to the extent that in FY24, almost 2/3 profit should come from non-edible oil business or say branded business. So in FY21, if non-edible oil business profit was only 10%, it's going to increase to 2/3, like 65% in FY24. This is more predictable business. This is more, say, sustainable business, relatively higher growth area, relatively high margin business. So nature of the business is changing. And we expect that that FMCG part of the business can grow 15% plus in revenue terms. If it is happening that way, our expectation is that earning overall for the company should compound at 20% plus CAGR for at least 3 to 5 years. And if we think about valuation, its valuation is almost at 50% discount vis-a-vis say peer group available. So when you go through this journey, obviously many up and down do happen. especially when we are living in a situation where we are talking about integrated world. Like earlier we discussed about the commodity price movement. So last year, just after say Russia-Ukraine war, we saw a scenario that edible prices started moving upward, like almost $1,500 to $2,000 sort of movement. And now it has come down to $1,000. So in a low margin business, if the volatility is like this, it does impact the say commodity part of the business, which happened in FY23. So it was drag on the overall performance. But now it has reached to the level that the probability again of going down further is relatively lower. So hopefully, say all the levers should play out in coming years. And as I mentioned again, that if fundamentals are good, earnings are coming, valuation are reasonable, then there is high likelihood that the return will also follow.
Right, Kuldeep. One question which has come in. Page Industries recently disappointed on its earnings. What are the views on Page?
So Page Industry, if we look last couple of quarters, two things are happening. First is the overall consumer demand had been relatively weaker. Second is that company is trying to make its supply chain more efficient, like they are implementing ARS, like automated replenishment system. Then what happened in those times, there is disconnect between the primary sales and the secondary sales. So in Q4 FY23, company reported 13% decline in the top line. If we think about consumer sales perspective, it was almost flattish. So 13% decline which the company experienced, it was more to do with that they are putting system in place so that they are better prepared for tomorrow. This particular say ARS implementation will go on for another couple of quarters. So our understanding is that in FY24 second half, it should start delivering the way it has done in past. Like if you look the Page history for last 10 years, 15 years, they have delivered 15 to 20% revenue growth and close to 20% earning growth. We do believe it should start happening in second half FY24 onwards. And from say medium to long term perspective, we will like to believe that mid to high teen earning growth is very much possible once these initiatives are implemented. So whatever happened, our view is it's more temporary in nature rather than anything changing from a structural prospects perspective for this company.
Thank you, Kuldeep. IT sector exposure is lower in the Golden Decade Fund versus the BSE 500 weightage. IT index and several consistent compounders in the sector have consolidated and available at lower valuation. Is there a case to include more consistent compounders of these IT sector in the portfolio?
So at some point of time, we had relatively higher weight in Golden Decade Fund. So it used to be high single digit. On time to time basis, we keep on taking this particular call, like whether we have to limit ourselves to mid single digit, high single digit. As and when we feel like it offer relatively high return vis-a-vis anything else we are say holding as we speak, we can definitely look at it. So it's more about say risk return trade-off. At the current juncture, we are okay to have this 4% to 5% exposure. If it's required tomorrow that we should increase the weight, we will.
Thank you, Kuldeep. Could you throw some light on the transportation and logistics sector? Lot of mutual funds have been launched on this theme. Any view to add or include any specific stock on this sector?
So we keep on evaluating those names. At times, the issue happens that the market cap, liquidity, there are multiple factors which we have to take into consideration. Because ultimately, these are the concentrated funds. Like whether Golden Decade or for that matter, any of our other funds, we have exposure close to 20-25 companies. So when we go for 3 to 5% exposure, we need to have a name available which is offering not only say decent growth, at the same time it should have a decent market cap, liquidity, availability. So we keep on looking the names which offer all of these, because that decide what is the impact cost and so on. So from medium to long term perspective, obviously the logistic is one of the area where a lot of things are happening. But only issue we have faced so far that most of the company are in the small cap domain.
Thank you, Kuldeep. Participants, please key in your question for Kuldeep to answer them. Kuldeep, we don't. Kuldeep, what's your take on Divi's labs and the API space?
So if we think about Divi's, this is one of the best companies available in India when we think about say API or custom synthesis business. So what they experienced was probably most sectoral driven phenomena, like most of the companies which have the API offering did suffer because their customers also were facing some challenges, and supply chain had the excess inventory, which is correcting now. At the same time, the companies which have the capabilities, they do also suffer because of the optical reasons. Because in FY22, Divi was one of the better performers both on fundamental side as well as the say stock return perspective. For simple reason, they could come out with say COVID related drug within short period of time, which provided say significant boost to the FY22 earning, like almost 48% earning growth happened in FY22. It led to a situation that you have high base and next year the COVID related tailwinds are not available. That correction happened in FY23. In FY24, our expectation is that mid to high single digit growth in earnings. And after that, on FY24 base, I like to believe this company can deliver mid-teen earning growth or higher, which it has done in past. So I would say it was caught in a situation that whatever wrong could happen has happened. And whether it was API or it was custom synthesis, every business got suffered in FY23 or recent quarter. All of this should change in coming quarter, and with every passing quarter, the thing should stabilize. And from FY25 onwards, we should have a decent earning growth trajectory for this company.
Thank you, Kuldeep. A question, what macro risks do you foresee in the next 1 year?
So macro risk, if you think agri play a big role in our own story, like 2/3 of the market is rural, rural population dependent. And consumption as a sector is having almost say 35 to 40% exposure coming from that area. So if you think about last year, urban was doing okay, rural was a drag, and expectation is that if monsoon remain normal, then the rural should also start coming back. That is the general thesis. Like for consumption story to play out or India story to play out in next 12 months, rural should do reasonably well. It hinges on that how the say monsoon is playing out, its implication for overall crop production, etc. And that will decide that whether some incremental disruption are there or not. Because if crop is not good, it can have implication for say food prices, which in other words can lead to say higher inflation led by the higher food prices. And then again, this say hiccup for a while, as long as the inflation is being concerned. So keeping fingers crossed and hope that in coming month or so, say first of all, numerical number for say monsoon play out well, and its a distribution as well. Because what's generally being reported is the overall India average, and it's having different meaning for different regions. And as I highlighted in the beginning, that weather itself has become quite erratic over a period of time. So that is one area which we will watch out for.
Right, Kuldeep. In the context of EV and automobile sector in general, how do you see the demand forecast in the next 6 months to 1 year?
So auto should do reasonably well, both a four-wheeler or say CV, etc. So generally, it's a cyclical sector. Last peak was made in FY19, and today we are on up cycle. So FY24 should be good, and if that is the case, that auto is doing well, most of the auto OEMs etc. should do well. As far as EV is being concerned, it's a long journey. Like today, EV's contribution will be mid-single digit depending on which particular segment we are discussing. Two-wheeler may be having higher, say, contribution as far as EV is being concerned. But overall, EV story will play out in next 5 to 10 years. So far, we don't find that any major issue in that regard. In last 1 year, say, they were concerned what will happen to the US, Europe, or China, because those are the major, say, countries where the EV proportion has risen. And as far as our exposure is being concerned, it's through Sona BLW, which is having large part of the revenue coming through the export to, say, US, Europe, or say, China. So if slowdown, recession happen, and it's having some implication for the auto for a while, then there can be some concern. But given the overall EV proportion in the global market itself is quite minuscule, I do believe if any concern happen, it will be more for quarters rather than years. And from say 3-year, 5-year, 10-year perspective, this is the right area to be in, and this is the right exposure.
Right, Kuldeep. Kuldeep, a question. What's the outlook on agrochemical space and PI industries in particular?
So PI industry, if you look, it had been one of the major consistent players, like especially if you think about PI, close to 25% or so will be domestic, balance is export. This is one of the few companies which has delivered the earnings on quite consistent basis, and it's not end of it. Like if we think about the say, prospects, this is probably among the only few companies which offer 15 to 20% growth from 5-year perspective on like-to-like basis. So while agrochemical in India offer only single-digit growth story, but if we think about the fortunes of for PI, it's largely dependent on export, and this company has a track record of delivering consistent earning for last many years, and we believe it should continue because the prospects remain the same for future as well.
Thank you, Kuldeep. Are we looking at new age companies like Zomato, Paytm after the moderation in valuation? Do they make business sense?
So if I have to put about ASK style, I would say we are more cash flow driven people. We do look for the earning growth. We do look for the return on capital employed. The issue with many new age platform companies is that they don't have earnings to showcase as we speak. So we keep on evaluating like where they are the prospects. So never say never. But at the same time, we had been the traditional investor, like always focused on the businesses which generate a lot of cash flows. And large part of the portfolio at any point of time is being built from those areas only. So at time we believe that whether it's Zomato or any other company which can deliver say earnings and that to sustainable earning growth, we will be looking those names.
Sure. Do you think we should include more small cap stocks for better delta in the portfolio?
So if you look overall portfolio composition, close to 57% is large cap and close to 43% is coming from small to mid cap. And we continue to scout for the name that which can offer the earning, higher earning, and for a longer period of time. So we are market cap agnostic to say in that way. We are looking for the leaders in the respective spaces, and at times those small cap name become the mid cap and mid cap become the large cap. So as and when we feel that the companies have the prowess to move from or to move this transition from say small to mid or mid to large, we do definitely take the exposure. Like APL Apollo, we would have taken in 2020. It was a small cap company. So was Radico Khaitan is a small cap company. So there are many companies which have covered this journey. And as I mentioned, like this particular strategy, we try to take the exposure for emerging leaders as well as the established leaders. And whosoever is offering better return risk trade-off, we go for those companies. So as I spoke, like close to 40% plus is the exposure we are having for a small to mid cap. If required, we can go for higher number or vice versa as well.
Thank you, Kuldeep. Participants, the last question for the day. Kuldeep, what is the portfolio churn or the turnover ratio of the fund?
So if you look, these strategies are having 20 to 25 stock. In any given year, we may change 5 to 6 names. In last 6 months, we would have changed only 2 names. So at times, it's a function of how the market is behaving. Like at times, all at sudden, more opportunities come. I will just give an example. During the COVID time, opportunities came from the areas where we were not present earlier. So rather than saying that there is any, say, a hard line 20% upper limit, it's not like that. It's all the function of whether we are getting something which is better than vis-a-vis what we already are having. So net, if you look last 4 years, 5 years, you will come to know that at any given year, if we have 25 stock portfolio, on an average 5 to 6 name may change, but that's it. Like we try to minimize the churn and the turnover because we try to figure out the story which have a long way to go, multiple legs. And if we figure out something, we try to stick with the name.
Thank you, Kuldeep. Thank you for answering all our questions. Thank you all for participating in this webinar. The recording of the webinar would be shared to your respective email IDs. Thank you once again.
Thank you once again. Thanks a lot. Good day.